What if I told you that investing just $100 a month could make you a millionaire, and you could do it without having to pick stocks, without day trading, and without getting lucky? It sounds almost too good to be true, right? But in this video, I'm going to show you exactly how this works using real, conservative numbers. More importantly, I'm going to explain the single biggest reason why most people never achieve this, even though it's completely within their reach. So, why do most people fail to build wealth? It usually comes down to a few core beliefs that keep them stuck. Many think you need a massive six-figure salary, or you need some kind of insider knowledge, or you have to have perfect timing to buy low and sell high. These myths are incredibly damaging because they make building wealth seem like an exclusive club that only a few can join. But the truth is, building long-term wealth isn't primarily about how much you earn. It's about how early and how consistently you invest your money. It's a game of discipline, not genius. The secret ingredient, the magic behind this entire strategy, is a concept you've probably heard of, but maybe never fully grasped: compound interest. Albert Einstein supposedly called it the eighth wonder of the world. Compound interest simply means your money doesn't just grow, it grows on top of itself. Your returns start earning their own returns. It's like a tiny snowball at the top of a hill. At first, it rolls slowly, barely picking up any snow. But as it continues to roll, it gets bigger and faster, accumulating more and more snow at an exponential rate. Your money works the same way. It starts small, but over time, the growth becomes explosive. Let's break this down with a simple, realistic example. Imagine you decide to invest just $100 every single month. That's about $3 a day, less than the price of a fancy coffee. Over a year, you've put in $1,200. Now, you're not trying to find the next big tech stock. For many people, that's money that's already being spent on things like daily lunches out, multiple streaming subscriptions, or those little impulse purchases that add up. So, let's run the numbers again. $300 a month, same low-cost index fund, same conservative 8% average annual return over the same 40-year period. What happens? That portfolio doesn't just triple, it grows to over $1 million. Let me repeat that. By finding an extra $200 a month to invest, your end result is over $1 million. It's the same strategy, the same market, the same returns. The only things that really matter are your consistency and the time you let your money work for you. This brings me to the most critical point of this entire video. Time is far more valuable than the amount of money you start with. Starting early beats starting big every single time. Let's imagine two people. Sarah starts investing at age 25. She only invests $100 a month. Her friend Mike waits until he's 40. He's earning more money. So he invests $500 a month, 5 times what Sarah invests. Assuming they both get the same 8% return and invest until age 65, who do you think ends up with more money? Even though Mike invested far more money out of his own pocket, Sarah, who started earlier with a smaller amount, would end up with a larger portfolio. That's because her money had an extra 15 years to compound and grow. Time is the most powerful asset you have as an investor. You can always earn more money, but you can never get back lost time. Once it's gone forever. That's why the best time to start investing was yesterday, and the second best time is right now. Of course, knowing this is one thing, but doing it is another. Most beginners fail because they fall into a few common traps. The first is trying to time the market. They wait for the perfect moment to buy, which never comes. Or they sell in a panic when the market dips. The second is chasing hot stocks. They hear about a company that's soaring and jump in at the peak, only to lose money when it corrects. The third and perhaps most common mistake is they stop investing during market downturns. They get scared and pull their money out, locking in their losses instead of buying more at a discount. And finally, the biggest mistake of all is simply never starting. They suffer from analysis paralysis, thinking they need to know everything before they invest a single dollar. Long-term investing rewards patience and discipline, not prediction or perfection. Before we wrap up, I want to be crystal clear about what this video is and what it isn't. This is not financial advice. I am not a financial advisor. This is for educational and informational purposes only. The goal here is to empower you with a fundamental understanding of how investing works, so you can feel more confident in making your own informed decisions for your future. The numbers we used are based on historical averages, and future returns are never guaranteed. So, if there is one lesson to take away from all of this, let it be this: consistency beats intensity. Starting small is infinitely better than not starting at all. The journey to $1 million isn't a sprint, it's a marathon. It's built one small, consistent step at a time. It's not about being a genius. It's about being disciplined. If you found this simple explanation helpful and want to learn more about long-term investing, passive income, and how to build wealth over time, make sure to subscribe to the channel. We post new videos every week designed to make these topics simple and accessible for everyone. Thanks for watching, and I'll see you in the next one.